Welcome back to another Econ podcast with Mr. Hagan. On this podcast, we're going to continue to talk about investing, but as I always say, this video is not designed to be investment advice. Its purpose is educational only. This video and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. Okay, so let's go continue talking about our second theory of the stock market, which is castle in the air or greater fool theory. And these guys say, don't worry about thinking about intrinsic value. Don't worry about thinking about P ratios and earnings and dividends and calculating yields and P ratios and PD multiples and all that hard work. Don't worry about these earnings. Don't worry about the company's dividends. Don't worry about those things. Instead, what you want to do is you want to worry about what you think other investors are going to do. So you want to buy before euphoric buying periods. You want to sell before panic selling periods. And we talked about this on a previous video. So what's a successful investor to do? How do you know when euphoric buying periods are going to happen? How do you know when selling or panic periods are going to happen? And some people would say, look, you can't know. You can't know these things. But the castle in the air folks, they're gonna try to come up with ways of figuring this out. So the question would be, under this theory, is how do we identify these periods? How do we identify euphoric buying and panic selling periods? So the way that we're going to do this is we're going to look at graphs of companies. Now, why would we do that? Well, prices. Here's the key. Prices carry information. They carry information about all the investors, all the buyers and sellers of stock are going to be captured. All their opinions are going to be captured in the price of the stock. So the question is, can we use price charts to learn about crowd behavior? Does crowd behavior fit into some recognizable patterns that we can identify and then use those patterns to identify euphoric buying periods and panic selling periods? So let's look at this price chart right here. So this price chart is, so this is over time. So we have time on the horizontal axis and we have price on the vertical axis. Okay. And this is the share price of some company, whatever the company is. And that company's share price is going to go up and down over time. Bouncing around, up and down, whatever. There's going to be the share price and what the share price does over time. And so what we're going to do is we're going to try to use looking at these price charts from the past and see if we can identify patterns. So here's one thing that a firm foundationalist might do. They might say, well, let's see if we can identify these low points if they develop a pattern. Do these low points identify a pattern? And so you would take all those low points and you would draw a line. And that line would be, that line might sometimes is called your support line, okay? Or your lower trend line. So your support line or your lower trend line. And what we notice is that even though stock prices kind of bounce up and down at a seemingly random pace, we can see that a pattern developed. And that pattern was that we hit a bottom and then we bounced off it. We hit another bottom and then we bounced off it. Hit this bottom, keep hitting this support line and we keep bouncing off it, bouncing off it, bouncing off it until finally we pierce that lower trend line. And we pierce that lower trend line. That's the language that we're going to use. We pierce that lower trend line right here. We pierced the lower trend line. We broke through that lower trend line. Okay? Right there, we broke through. The pattern had come to an end. The pattern of bouncing off this lower support line came to an end, and we pierced that lower trend line right here. And so that becomes a sell signal. If you pierce the lower trend line, if the price pierces the lower trend line, then that would say that the pattern has come to an end and panic selling is going to occur. Now, that's just the lower trend line. We would also do an upper trend line where we would try to recognize the upper points, and we would draw some kind of upper trend line that might look like this. Sorry, I did a bad job. Let's try to draw that again. We might have some upper trend line. Looks like that. And we never pierce the upper trend line. Now, I'll talk about an example of that here in a moment, but we never pierce the upper trend line. We pierce the lower trend line. So here's what you would do. Here's what these guys might start by arguing. Now, and this is a very, very super basic trend lines that we're looking at. They get much, much more complicated than this. But a super basic trend line is we draw an upper trend line, we draw a lower or support trend line, and when we break one of those trend lines, when we come out of the trend, that gives us a signal. That tells us that either panic selling is going to start happening or euphoric buying is going to start happening. In this case, we pierce the lower trend line. Piercing the lower trend line indicates that panic selling is happening, as panic selling is about to happen. And, in this case, it did. The share price then started going down. Okay? So what happened here is if you pierce, in this case, if you pierce the lower trend line, then that becomes a sell signal. That would be the argument. Okay? Now, let's try this again. Only this time we're going to just change the graph up here a little bit. Sorry about that. We're going to change the graph up a little bit. So here we have time on the horizontal, and again we have the share price on the vertical. Time on the horizontal, share price on the vertical, and here we have some other company. And this is their trend line over time. This is what their share price has done, over time. And now we're going to draw trend lines on there. So we're going to draw an upper trend line. So identify some of these upper points. Here's some of our upper points. So I'm going to draw an upper trend line. Here comes my upper trend line. Sorry about that. Upper trend line right here. And then we're going to draw a lower trend line, which I think, I see some point here, maybe here, here, here. And I'm going to draw my lower trend line. I'm going to draw my lower trend line. There's my lower trend line. So I have my two trend lines. And now I want to say, where does the pattern break? We go up, hit the upper trend line, come down, hit the lower trend line, and we just keep bouncing off of those, back and forth, back and forth. Where does the pattern break? The pattern breaks right here. The pattern breaks right there. Right there, we pierce the upper trend line. So right there, we pierce, in this example, we pierce the upper trend line. Pierce the upper trend line. And what does that tell us? Piercing the upper trend line gives you a buy signal. That would be the argument. Now, where's this argument come from? Well, the argument would be this. The argument would be that in the past, when we look at stock movements in the past, that when you have a pattern of hitting the upper trend line and then you break through that upper trend line, share prices tend to go up. And that's why we would give a buy signal. This would be euphoric evidence that euphoric buying is about to happen. And this, you got to be careful. It gets confusing because you look at this and say, wait a minute, Hagen, the price is high right here. We don't want to buy when the price is high. Yeah, but the price is low compared to where they're arguing it's going to be in the future. Okay? When you pierce the upper trend line, that's the buy signal. Piercing the lower trend line, you might say, well, the price is relatively low right here. No, it's high compared to what's going to happen, which is the share price is going to go down. Okay? So these are some very basic patterns that the Castle in the Air people would use to try to say, when are euphoric buying periods going to happen? When are panic selling periods going to happen? And you want to buy before the euphoric buying periods. Sorry, that was right here. You want to buy before the euphoric buying periods, and you want to sell before the panic selling periods. That's the idea. Okay. Now, one other thing, by the way, there's a lot of people that would argue that this firm foundationalists, many of them would argue that this doesn't work. Okay. You can't predict the future. You can't use these fancy graphs and trend lines to predict the future. Futures just they're unknown by definition. So I just want to say it's debatable whether or not this is effective strategy. Okay, but this is what the argument would be. Now, there's one other frame just came up that I want to show you, and those are just some basic vocabulary words. Okay, some basic vocab terms. When share prices are going up, that is called a bull market. Okay, that's called a bull market. When prices are going up, that's called a bull market. And you might just remember that from this letter U right here. When prices are going up, it's a bull market, and we call that a bull market. And when prices are going down, we call that a bear market. A bear market is when share prices are going down. Okay, and there's some reason for this. I don't remember what it is. At some point I read it. You could probably go read about it. You could find it somewhere online where these terms came from. There was a reason behind it. I don't remember what that is anymore. Bull market is the term we use when the markets are going up. Bear market is when markets are going down. All right, this has been another Econ Podcast with Mr. Hagan. Thanks for joining me, and we'll see you on the next Econ Podcast.